Welcome to the third video for our projected benefit obligation chapter. This is chapter 17 in intermediate accounting, and in this video we're going to be covering another tough topic, which is pension expense. So we're going to go all the way from the beginning to end of how to calculate the pension expense. So let's go ahead and jump right in. This is the final video though for chapter 17. So once you get this down pat, and if you've watched the other two videos, then this should really help you to get through this challenging chapter. All right, so first we're going to look at the changes in the projected benefit obligation. So we have got that obligation there that we know we're going to have to pay out the employees once they retire, because this is a defined benefit pension plan. So then we've been setting those amounts aside in the plan assets. So we're going to look at the changes in each of these, and then we are going to pull from those to figure out our pension expense. So we're looking at 2037. So this is where the employees have been working there for many years, and at the beginning of 2037, we had a pension, or the projected benefit obligation, of $465 million. We only had in plan assets $420 million. So I'm just comparing these two charts here. So when it comes to the projected benefit obligation, we talked about each of these things in the last video. We have the service costs that have added to the 2037 amount. So during the year, we have all these employees that have another year of service. So that's going to increase how much they're going to get paid in retirement. So we're going to add $47 million to that. Then we have our interest cost. Remember, interest is always based off of the percentage they gave you, which is 5% in this case, and it's based off the beginning projected benefit obligation. So that was 5% times 465 million. Then we have a loss on projected benefit obligation, and they're telling us that is 25 million for all of those employees. We have a loss there. And that could have been for a number of reasons. Could be that we've seen that a lot of employees, we actually expect to get paid more than what we had planned for by the time that they retire. So we had to up that amount. So if it's a positive amount here, it's a loss because it's adding to how much our pension obligation is going to be. Then we subtract out any amount that we've paid to any of our retirees. So we paid out $54 million to the retirees. So that's going to decrease our obligation because we have another year done for those who have already retired. So that brings our projected benefit obligation to an end at 2037 of $506 million. If we jump over to the plan assets, here's all the things that affect those accounts. So we have the actual return on the plan assets. We said in the last video, the actual return was 9% times the 420 million. We projected it was only going to be 8%, but it ended up being 9%. So that gave us 38 million. Then we also saw that we contributed 62 million to the plan assets, because every year the company is going to put more into this account and watch it grow so that as their employees retire, they have that money set aside. Then, just like we saw in the projected benefit obligation, we paid out 54 million. So in this case, our assets decreased by 54 million because we paid some of that out to the retirees. So at the end of 2036, we have 466 million sitting in that trust account that hopefully is also earning, as we saw here, earned a 9% return, and hopefully it will continue to earn that money as we see more and more employees retire. Some other things we want to take into consideration, and you might want to take a picture or a screenshot of this right here, because I'm going to be referencing back to this for the rest of this video. So some other things that are going to come up at the end of the video: assume that prior service costs of 45 million were incurred at the beginning of the previous year due to a plan amendment increasing that projected benefit obligation. Also assume that at the beginning of 2037, the company had net loss of 76.5 million. So the average remaining service life of the employees is estimated at 15 years. All right, so 15 years is going to be important, and those two bold numbers are going to be important as well. So then we get to our pension expense. We're going to pull in all of the things that are relevant to our pension expense down here at the bottom. So we have service cost of $47 million from the projected benefit obligation. And I'm going to break each of these down very closely throughout the rest of the video, and then we'll record the journal entry at the end. Woohoo! So then we have the interest cost, $23 million, that we also got from the PBO. Then we have our expected return. Okay, pay close attention to that. It's not the actual return, but the expected return of $34 million. So we're going to subtract that because that is less of a cost. We had a return. So here we're going to use the expected return. Then you're going to see these when we get to the slides that break down each of these. We have the amortization of the prior service cost that we saw in the last slide, and amortization of net loss that we saw on the last slide. So I'm going to show you how each of these are calculated, then we'll make the journal entry. So our total pension expense is $41 million. Same numbers right here, but now we start breaking them down. So for the $47 million for those service costs, we've already talked about it, but let's just go through it one more time. That is the service cost that represents the increase in projected benefit obligation that was due to our employees working there for another year. That was the employee's service. So this is the first component of our pension expense. So it was $47 million that was calculated outside of this, saying that shows there's another year of our employees working here, which is going to increase how much we are obligated to pay them. Then we get to our interest costs. And I already told you, that's just the 5%, the number they gave us, the 5%, and it's multiplied by the beginning projected benefit obligation, which was $465 million. So 5% times 465 gave us $23 million. And remember from the last video, our interest cost, it's not because we're actually having to pay interest on this obligation, but instead it all has to do with the time value of money. We are now 1 year closer to having to pay out our retirees, so that is going to be called interest in this case as we get closer and we have less time. Then we get to our expected return on plan assets. So whenever we calculate our pension expense, we are not going to use the actual return. Instead, we use the expected return. We had expected to only earn 8%. So that's what we thought our assets would yield. So our plan assets, they're put aside in a trust. They are invested in stocks and bonds and other types of investments. And a yield means the return. We thought we were going to get 8%. So we use that expected amount. We do not use the actual. The increase is basically going to be a gain for us. So it reduces the pension expense because that is less that we have in expenses because we got some money to go towards it. So we didn't have to give all of it ourselves. Some of it came from earning from the money that we had set aside and invested. That's what we want to do in our lives, right? We don't want to have to earn all of our money. We want our money to have a return as well, and that will decrease how much we have to set aside for our futures. Then we get to the two tougher aspects of this that we haven't dug into yet, but this comes from that first slide where it had the different amounts in the little bottom there. And that was, first of all, the amortization of prior service costs. So we had some prior service costs, and we are going to split that over the remaining service life of the active employees. So they chose to do this because it was a large amount. It was $45 million, as you saw. They have 15 years that they can split it across. That's going to be the average number of years until the employees retire. So they said, you know what, let's just split this across. We don't want to add all 45 million to 1 year. So we're going to divide it by those 15 years, and we are just going to expense out 3 million per year. And that's totally acceptable. When they do that, and we'll see this in the journal entry, that is put into other comprehensive income, which ultimately is moved to accumulated other comprehensive income, so AOCI. So that was not too bad, right? We took that prior service cost. They said, whoa, this is too big to expense all at once. Let's split it up over the service life of the employees that this is relevant to. This one gets a little bit trickier when we say amortization of net loss. So we're going to have a couple slides for this one. So that net loss If it's too large for the pension expense, then we're going to be amortizing that, just like we mentioned with the prior service cost. So the too large amount is anything that exceeds 10% of either the projected benefit obligation or the plan assets, whichever amount has a higher balance. In our case, it was the projected benefit obligation. So we're going to be using the 10% of the projected benefit obligation. Anything over that, we are going to go ahead and amortize over time. We call that too large amount the corridor. We're going to call that, anything over that is going to be the corridor. Okay, so that's what that reference is. So let's look at how we calculated this. So the corridor is not charged to the expense all at once. Instead, it's going to be over time. So the excess over the 10% is smoothed out over the remaining average years, which in this case was 15 years. So we saw that for our active employees, they have on average 15 years until they retire. So we're just going to smooth it. We're just going to expense it over those 15 years. So the calculation for that, I keep teasing you with it. We have a net loss, as you saw on that first slide, of $76.5 million. It is 10% of, we take 10% of the 465, the beginning projected benefit obligation. So that would be 46.5 million. So the difference here is 30 million. So the excess, the corridor, is 30 million. And we have to amortize that over the 15 years of the average remaining service life of those active employees. So we divide that and it comes up with 2. We're going to amortize $2 million every year from this. So we take the net loss minus that 10%, and they say all of the excess, let's smooth it over time. So we have $2 million over the next 15 years. So what do we do with all that? So let's move to our Forever Fit gear. So they record the loss to other comprehensive income. I'm trying to say accumulate other comprehensive income for the 25 million loss that occurs in 2037. So we saw that loss on that first slide I showed you in this video. It revises its estimate of future salary levels because they said, hey, we think they're going to make more money in the future. So there's actually 25 million more that we need to have in the projected benefit obligation. So this was outside of the pension expense, but we want to make sure we record this as well. Forever Fit also records a $4 million gain to other comprehensive income. And what is that for? It's for the extra $4 million that they actually earned on their plan assets that they didn't expect. So in the pension expense, we showed the expected return, but then the extra that we returned, we're going to show as a gain. So here's our 2 entries. The first one is that 25 million, we're calling that a loss. And that would be a debit to other comprehensive income, just like you would debit an expense, just like you would debit a loss. Same thing here with other comprehensive income. We are going to debit that 25 million. And then we are going to credit the projected benefit obligation. We're going to credit that liability for the additional 25 million that we need to have set aside because now we're thinking the salaries are going to be higher when these employees retire. Then again, we actually earned 38 million. We actually earned 9% on our plan assets that we had invested. We only expected 34 million. So the way that it goes is they put the 34 million as bringing down the pension expense, and then they take that extra 4 million and they're going to put it as into plan assets with a debit, and then they credit the gain that goes into other comprehensive income. So we've talked about other comprehensive income for a long time, and we don't really get into it too much until now, but we said that there's going to be gains and losses from our pensions. Well, this is it right here. This is what we've been looking at. We see a loss because we now expect the salaries to be higher, and we see a gain because we now are earning more than we had expected on our plan assets. So very easy to miss this with the expected versus the actual return on the plan assets. So make sure you pay close attention to that. All right, then we get to our pension expense, and here's how we're going to record that. So here's all the numbers. We went through how we got each of these, and here's the journal entry. So we always debit our expenses. So we debit pension expense for the total, the $41 million. We also debit the plan assets because, as we talked about, it's decreasing the expense. It's a good thing. We made money off of the assets that we invested. Then for our projected benefit obligation, it is going to increase by the sum of the service cost plus the interest cost. So those top two numbers, the 47 plus the 23, give us 70 million. We are going to increase that liability, the pension or the projected benefit obligation. Then we are going to take the two amortization items, and both of those are going to go to our other comprehensive income. So we have the amortization of prior service costs and amortization of our net loss. And those are going to go to other comprehensive income. All right. We're getting so close to the end. Y'all are doing fantastic. So remember these numbers from our plan assets. We started out with 420. We had actual return of 38, but we only expected 34. We contributed 62. Then we paid out 54. So for the 62 million, we are going to show the plan assets increase and our cash decrease because we took cash out of our bank account and we put it into this trust account set aside for future benefits that we had to pay out to our employees. And the last journal entry of the entire chapter, we are going to show that we are decreasing the projected benefit obligation for that 54 million that we paid to our retirees. And we decreased the plan assets because it left the account and went to the retirees instead. So that's it. So simple, right? All of our post-retirement benefits. No, I know this is a really hard chapter, but we made it through. This duck here has been going to our Forever Fit gear, getting in shape, while we were learning about how to account for their post-retirement benefits within the company. So hopefully these videos have helped because I know it's a challenging chapter. Make sure that you continue to watch as we walk through the remainder of the chapters in intermediate accounting.